Now, if we also take a look what's moving to the upside, we do have gold and silver both trading higher. Gold up 0.25%, still in the sideways pause, which is a healthy pattern. If we look at silver, it's up 1.8% in the sideways pattern as well, holding its ground. You can see it did dip into an oversold territory. It gapped down and quickly got bought back up, has been drifting higher, and the charts are still holding their bullish chart patterns. If we take a look at miners this morning, like GDX miners are set to open a little bit higher, so there's a little bit of excitement there. If we go take a look at the energy space, oil is neutral. We've got oil drifting back down. Now, somebody mentioned that there was a bull flag on the chart of oil, and this is the chart that they shared, so I just want to kind of touch on that. I don't see a bull flag here. Bull flag to me would have been this move up and then this little bit of a flag right through here based on this like 2-bar pop. We got the markets moving higher again this morning. We've got the Nasdaq up 0.4%, the S&P 500 up 0.3%. The Russell is relatively flat, so we're a little heavy weighted on the large tech. Now, if we take a look at the S&P 500, our 30-minute sentiment chart here and momentum chart, we've gone from green bars to neutral to red bars. We have dipped into this the downtrend and with these waves of FOMO. Now, we had FOMO last week as well, going into the weekend, and we talked about when you have FOMO closing on a Friday, that usually carries over for a move up and it creates a lot of excitement. And yesterday we ended up getting some red shaded bars in the background here. If we just zoom in a little bit, you can see we've got these red shaded bars telling us we're a little bit overbought, meaning prices moved too quickly to the upside and far enough that it is more or less showing signs that we are running into a little bit of resistance. Now, we are running into previous highs. The market is set to gap slightly higher this morning. We did pretty much have FOMO for a good chunk of yesterday's session. So there's definitely a bit of a feeding frenzy of people piling in. This market is trying to carve out a bottom here. The big question is it a bounce into resistance and going to get sold back down and it's just kind of sucked everybody in? Or is there actually some underlying strength and the momentum is shifting to the upside? And that's what we just have to kind of wait and see. It's we don't want to jump the gun. If you look at the daily chart, you can see it's been a very strong bounce, but that's what happens in downtrends. We do get very strong bounces. We still have a series of lower highs. We've got a series of lower lows. And we're just kind of letting the technicals and the momentum kind of guide our way versus trying to throw trades out and hopefully they stick. Now, just a quick reminder, with my videos here, I don't provide any trade signals. I provide analysis. I do keep all of the ETF trades for premium subscribers who subscribe to the adaptive compounding strategy, which we call the ACS strategy. If you want to copy the exact trades I do in my portfolio.
Despite the latest rebound, the longer-term chart reveals a market still defined by lower highs and lower lows, classic downtrend behavior. Strong rallies often appear during declines, but they rarely signal a lasting shift unless supported by a meaningful change in momentum. Analysts warn against making emotional trades during these counter-trend surges, emphasizing discipline over speculation. Many investors attempt to preempt turning points, only to find themselves positioned against the prevailing trend. As uncertainty builds, the prevailing strategy among seasoned market participants is to let technical indicators guide decisions rather than chase short-lived excitement or react to daily volatility.
If you want to avoid bear markets and still profit and not worry which way the markets go, you can copy my ETF trades. You can see our equity curve versus the S&P 500 versus the 60-40 buy and hold. You can see the difference down here. Now, who I help the most are people who have a significant trading account, who's close to retirement or retired, and they want to protect their capital and they want to keep it growing no matter what the markets do. You can see the most valuable thing, which most people don't seem to appreciate, is the maximum drawdown. The biggest loss our portfolio can take through the peak of before the 2007, 2008 financial crisis to where we are is less than 6% versus the S&P 500, the buy and hold strategy, very dangerous. And you can see our average annualized return over here. Now, while the strategy does have high returns, it really is a very slow strategy. It's very simple, 5 to 12 trades a year that you can do trading ETFs. We have 1 or 2 ETF positions open at a time. and we just rotate from one asset class to another. It could be equities, bonds, currencies, cash, what have you. Anyways, if you're interested in that, you can always go to our website, TheTechnicalTraders.com, check out our service, and of course, you can get on the free newsletter if you want to join. And really, I can help you if you've missed the rallies, if you're on the wrong side of the market already, if you're worried the market's topping, you don't have a strategy, all of this stuff, I can help you outperform the markets with a lot less stress, and you just have to really follow and copy what I do. I manage my own portfolio, and I share exactly what I do with subscribers.
Beyond equities, the macro picture is mixed. Treasury markets remain choppy after a short burst of volume, drifting within an upward channel but lacking conviction. Meanwhile, the U.S. dollar is regaining mild strength as global investors seek stability amid geopolitical tensions and shifting rate expectations. Precious metals continue to show resilience. Gold consolidates constructively after recent gains, and silver outperforms with strong intraday buying. Mining stocks mirror this cautious optimism. These movements reflect a broader theme. Investors are hedging against uncertainty while still searching for assets that can benefit from inflation risks, currency volatility, and the ongoing recalibration of interest rates.
Now let's see what else is moving today. We have bonds trading a little bit lower, down 11 tenths of a percent here. They've had a nice pop, lots of volume recently. Overall, they're just kind of trading more or less sideways. If we look at the recent price action just from here, really just kind of chopping sideways. When we zoom out a little bit, it's channeling to the upside and kind of at the lower end of the channel. So we'll just let that work itself out. If we take a look at what else is moving this morning, we have the dollar up 0.2%. So it's just starting to find a little bit of a bid this morning. Really, it's just getting back. It lost a little bit and it's bouncing back in the past 20 minutes. The dollar index is holding up. It's got the moving averages all layered the way you kind of want them for something to be trending higher. So it's still in a consolidation and a bottoming kind of phase here with this resistance area that I think we could see it eventually extend and move higher. Now, if we also take a look what's moving to the upside, we do have gold and silver both trading higher. Gold up 0.25%, still in the sideways pause, which is a healthy pattern. If we look at silver, it's up 1.8% in the sideways pattern as well, holding its ground. You can see it did dip into an oversold territory. It gapped down and quickly got bought back up, has been drifting higher. And the charts are still holding their bullish chart patterns. If we take a look at miners this morning, like GDX miners are set to open a little bit higher, so there's a little bit of excitement there. If we go take a look at the energy space, oil is neutral. We've got oil drifting back down. Now, somebody mentioned that there was a bull flag on the chart of oil, and this is the chart that they shared, so I just want to kind of touch on that. I don't see a bull flag here. Bull flag to me would have been this move up and then this little bit of a flag right through here based on this like 2-bar pop.
In the energy sector, oil trends remain weak despite brief attempts to rally. What some interpreted as a bullish flag was merely a short-lived uptick within a continuing downtrend. Without sustained momentum, the pattern lacks the structural balance that typically defines reliable continuation setups. Industrial metals are equally mixed. Platinum and palladium drift sideways as they await clearer demand signals. Copper, an economic bellwether, sits near resistance. While long-term demand may rise due to data centers, electrification, and AI-driven energy needs, slowing global growth could exert downward pressure. Commodities now trade at the intersection of optimism and macro fragility.
You really don't want the flag to be that long. Things need to be balanced. When you look at patterns, you kind of want them to be balanced and symmetric. So we really needed this thing to either pop and continue with a high momentum move there, or it really needed to pop and start to move there. But now it's just a trend. It's a downtrend. It's just it's popped. It's literally a 2-day pop, and it's just been fading down. And it's back down, getting into this support level down into this area. So I think the key tip here is just to understand if it's a quick pop, you really need a small, quick, tight flag, and you need it to continue. The longer a flag goes out, the less likely it is going to play out, and continue, which would be to the upside, and then eventually just turns into a downtrend in this case. So that's kind of where that is. Overall, if we look at the charts, oil is continuing to be down in this lower zone. And I think at any point here, it could break down if we have some poor economic data or bad data from potentially a big company that's saying things are slowing. So let's take a look at a couple other metals real quick. We've got platinum. It is consolidating sideways as well, trying to figure out what it is going to do. If we look at palladium, very similar type of price action. It's fizzled down. It's consolidating, potentially getting ready for another launch to the upside. If we take a look over at crypto, we've got Bitcoin down 0.5%. I'm not a fan of this chart. Clearly, it's in a downtrend, a little oversold into support, but I wouldn't be buying into this thinking it's going to bounce. It could very easily have a very big unwinding still.
In cryptocurrencies, both Bitcoin and Ethereum struggle to establish direction. Despite reaching oversold territory, neither chart suggests a durable bottom, and history shows that the most dramatic declines often occur at the end of downtrends. Attempting to time reversals can cultivate dangerous habits, as brief winning trades disguise the risks of bottom picking. Turning to equities, tech giant Nvidia appears vulnerable. Weakening price structure and broken support levels hint at a potential shift in market leadership. A significant breakdown could trigger broader selling across AI-related stocks, amplifying volatility and challenging the market's reliance on mega-cap technology to support overall index performance.
And this is where most people get into trouble. They try to pick a bottom, and just remember, a lot of times some of the biggest moves happen right at the end, meaning we could see it like sell off. It could have a very big flush down and then bounce back up to where you thought it was going to bounce. I covered this yesterday, I think, in more detail. If you do catch a bounce, if you get long and catch a bounce and it bounces up, it's just reinforcing a bad habit. If you win it, then you're just lucky. That's kind of the way that I see it. I don't like to buy things falling. The odds are it's going to trade sideways and continue to fall than it is to bounce. So just be very aware. It is, if you try to pick a bottom and you nail it, yes, there's big, quick money. But again, most of them fail, and it's teaching you a pretty bad habit in terms of how that's going to unfold. Let's take a look at Ethereum. Some of you want me to touch on that real quick. Let's just look at the big picture here. Pretty noisy chart. When we look at it, you could just say, okay, well, it's in a pretty big range. It's got some pierces to the upside, some pierces to the downside, and is kind of near the lower end of the range. But really, it is, other than these waves, it's pretty trendless. If we take a look probably at the weekly chart and bigger picture, I'm not sure how far back this goes. Here we go. Overall, not a big fan of that as well. Crypto's just kind of fallen out of favor, and it's trying to figure out what it wants to do. Let's take a quick look at copper. I don't have a whole lot of insight on copper. I used to track it, but I don't really track it anymore in terms of giving much insight. It doesn't give a whole lot of insight. I'll just flip over to, let's go to the monthly chart. When we look at it from a big picture standpoint, we've seen it, really kind of channeling its way up here. It's got these upper bands, got this, this lower kind of range, however you want to draw these levels. It is kind of messing with the upper end of the range. We can see it went up here with tariff stuff and then got slammed back down. It's back up into a resistance area.
The equal-weighted S&P 500, often a more accurate gauge of underlying market health, now trades directly into overhead resistance. This positioning places markets at a crucial decision point: either break through and confirm renewed strength, or retreat and reinforce the broader downtrend. Seasonal influences also play a role, as holiday periods typically bring lighter volume, allowing markets to drift higher in the absence of large institutional sellers. But thin liquidity can exaggerate both gains and losses. As the week unfolds, traders must distinguish between genuine momentum and holiday-driven optimism, waiting for price action to reveal whether buyers or sellers hold control.
However you want to draw those, I'm not a fan of it. I do think it's kind of at the upper end of the range. And if the economy does weaken, I think we're going to see copper have a pretty big unwinding. Mind you, this whole tech wave and AI and new power plants, and obviously we're going to need a ton of power. That bodes well for copper demand, probably silver demand as well for electricity. So that's kind of, there's that to the upside. And maybe that's why copper's holding up. There's going to be a lot of demand going forward. But overall, it is kind of at resistance, and it doesn't look the greatest. Looking over at Nvidia, it definitely is not performing the greatest. It really is kind of starting to break this level. It's trying to figure out what it's doing. It's a little bit messy of a chart, but it is moving lower, and that's not a good sign. If Nvidia starts to break down the price chart, it hasn't really broken down just yet. It's starting to break down. It's broken a couple significant pivot lows. But if it does start to move lower and start to head down below this level, I think this is going to be a fairly critical level, this pivot low and this pivot low here. If it starts to break that 164, 165, then it could be a very big unwinding. And just this one stock alone could do a lot of pulling down on the market and drag it. That could turn the tides. And of course, if it starts to sell off, people will probably start to sell off other AI and big tech stocks as well, and create a bit of a landslide. I think one last look here is just to look at the RSP ETF. Now, this is the equal weighted S&P 500. And it has really kind of gone from a series of higher highs to a bit of a double top to lower lows. We're right up into resistance. This looks like we could see this market get rejected. So we're at this really critical turning point. As I mentioned at the beginning of the video, we need to see if the momentum is going, if there's a positive flow, if the momentum is holding, and we're going to see the market turn up from a technical standpoint, from price and money flows, or if things are going to get rejected. We are into obviously Thanksgiving here, so we've got usually you see a holiday kind of rally and a push higher. It usually favors higher pricing. Usually lighter volume favors higher pricing. Big kind of wealthy players step away early, and they've already done their selling. A lot of them, or they'll be doing their selling today if they have any, and then they go on holidays and enjoy the time off. And if the big sellers aren't lurking around, then the price naturally drifts higher. Low volume favors higher pricing. You typically need heavy volume to drive the market down.